Thank you so much for tuning in to Morning Markets. I'm Amber Canwar. We are watching these U.S. bank stocks, and broadly, they are coming in better than expected. I mentioned that key metric of profit, net interest income, rising, and they say that those good times are going to continue to roll, especially at JP Morgan and Wells Fargo. You'll note that Citi is a little bit under pressure. One of the things that could be holding them back is their capital ratio was not as elevated as expected, and their charge-offs grew by 78%. So a little bit of signs of cracks under the surface, but certainly they are proving right now that big is better, even with those cracks forming. Let's bring in Andrew Pyle. He's Senior Investment Advisor and Portfolio Manager at CIBC with Gundy. We've also got John Zechner joining us, Chairman and Founder of Zechner Associates. Gentlemen, thank you so much for being on the desk with us, where we are trying to figure out what to do with these bank stocks, what it's telling us about the broader economy. Andrew, let's start with you on the desk here. It is, I guess, a little bit of a sigh of relief that there are no major cracks forming.
No, this has been a great week, obviously, in terms of the disinflation trade, Amber, and we cap it off on a Friday with bank earnings that, largely, to your point, came in better than expected. Some of that really because I think some of the banks have lowered the bar in terms of what they were providing guidance for example, on net interest income. A lot of them have beaten on that. But this really fuels this risk-on sentiment that if the banks are doing better, we can forget what happened in March, focus forward. And the economic guidance coming out of some of these earnings reports are also positive, and that's fueling this kind of improved sentiment in the market.
John, I'd love for you to pick up on that point, because there are certainly areas of weakness. Charge-offs are increasing. They are cautious about how they talk about the economy. That might not dent the big players, but if they're seeing those headwinds, what does that mean for some of the regional banks who would feel that a little bit more acutely?
Yeah, that would be the tale to tell, Amber, going forward. I'll be interested to see some of those regional bank results, because when you look at the majors, it should be no surprise when you think what happened in the first half. Basically, the economy held in better probably than most people expected at the beginning of the year, so that's a bit of a tailwind for them. Obviously, the big players benefited from what was going on in the regional banking crisis. Obviously, with JP Morgan picking up the remnants of the First Republic, as well as bringing that on board, so their funding costs were lower, the deposit costs were lower, and capital markets activity. Well, we know stock market was stronger than probably most people expected it was going to be in the first half. IPOs came back in, particularly in the tech sector and other areas, so there was some buoyancy there. So overall, it should be no surprise that these banks did fairly well. I'll probably take more glass half empty versus glass half full look at that, because I think we really want to be looking forward from here on in, and what happens economically. So I think that's the bigger issue, and I don't think you're getting that indication from the big players yet.
And I think that's being reflected in the stock action that we're seeing, the initial enthusiasm kind of waning a little bit. So let's get down to brass tacks. Are you buying any of these banks? Do you continue to hold them? Did you hear anything today, Andrew, to change your mind on your investment thesis?
Well, I think a couple of things that John referred to. Capital market activity has been outstanding for the first 6 months this year. Do we really think we're going to continue that into the second half? And we're in the camp that we're probably not, that we're not going to see the same type of gains that we saw in equities. And even the bond markets are going to be challenged here. You can have this improved economic or resilient economic environment, which JP Morgan, spoke to this morning. But that same environment, and when you look at these consumer sentiment numbers, Amber, they're suggesting the Fed's work is not done, that you've got strength that's going to allow inflation to keep feeding through. We're going to see further rate hikes. May help banks on the net interest income margins, but will ultimately hurt consumers and hurt the economy. So this is going to be extremely challenging. So we are buying banks, but we're not extremely bullish at this point because we have to deal with that second shoe to drop.
Which one of these three are you buying? JP Morgan, Wells, Citi?
We continue to look at JP Morgan. Okay. We love the stock. Citi is more of a value play for us, and it's been a very painful value play for a lot of investors. We do think Citi's on the right track right now. They still have some issues. Credit cards are going to be their biggest challenge going forward because of obviously the risk of delinquencies and defaults on credit cards. But I do think the diversified model that they now have gives investors at least a better medium to long-term view on Citi.
John, what about you?
I'm in the same camp as Andrew there in terms of the names. You know, we own JP Morgan right now. We got out of Citi a while ago just because of obviously profitability issues. Bank of America looks pretty good as well. TD and BMO up here, we are along, in a little CIBC. But having said that, I'm more of a net seller generally right now because I think there's decent momentum in the markets, and the banks have lagged a little bit, so they're probably a good safe place to be in the short term. But overall, I've got concerns on the market. So yes, we own those names, but I'm not a buyer of any of them today, that's for sure.
That's interesting, and I will pick up on that. These gentlemen are with us for the whole half hour, so we can take our time a little bit. But you mentioned some of those Canadian banks, John, and when we are looking at on the TSX, TD is showing a little bit of signs of life here. It has been the lagging performer. What does a set of results that we've gotten so far mean for Canadian banks that are exposed to the U.S., John?
Well, the exposure to the U.S. is more in the regional side. So as I said before, you want to see what starts to happen with the regional banks. Like clearly, TD had a big win by being able to walk away from First Horizon and up their capital ratios. BMO has the big exposure now because of their Bank of the West acquisition. So I'll be interested to see, what comes out in those numbers. But that's not going to be until late August as well. But the Canadian banks are generally very well capitalized. On the other side, I think there's maybe more risk in the Canadian economy for all the rate increases you've seen because, the consumer is much more highly levered in Canada than in the U.S. And I think there's a little more air under the housing market here.
John sounds like he's a little bit cautious on the Canadian banks. At the same time, Andrew, people talk a lot about valuations and that there's been a historically great trade to buy them where they are right now and sell them when they start to rally up.
Exactly, and that's what we've been doing. I think Canadian banks have been disproportionately impacted by what we saw in the States back in March. It's not to say there's no risk to Canadian banks that have exposure in the States, but I think the market really went beyond itself in terms of the decline that we saw in Canadian bank valuations. We still like Canadian banks. We continue to buy the banks at this point based on valuations. The risks, I think, are really the same that we're going to see in the States with respect to competition for deposits, right? We're going to see that here. We just had a Bank of Canada rate hike. Prime rates now are above 7%. Prime plus one loans are now north of 8%. I think we're going to see a situation here where consumers and households that are extremely leveraged are now going to look to paying down debt, which means taking money from something else. And I think you may see that in the States as well. So banks are going to be challenged on the deposit side and in terms of debt pay down. So
what are the levers to pull? This strikes me as we came out of Canadian bank earnings. This was now the second time in a row where it felt like they're challenged in every single one of their markets. But as I look at, JP Morgan, for example, they saw expenses go up, but they managed that pretty well. A measure of their operating efficiency came in pretty good. And so on the cost side, do the banks have a lot of room there is there a low-hanging fruit on the cost side?
There's not a lot of low-hanging fruit, right? And I think banks, especially in Canada, still need to be diligent in terms of maintaining costs, maintaining efficiency, because it is going to get challenging going forward. The one thing I think that Canada has in its favor right now is a housing market. That we've seen a housing market right now prove to be more resilient than what a lot of people last year thought would happen, given the magnitude of rate hikes that we saw, Amber. And we also have a population growth story in Canada that we don't have in the States. You could argue Florida might have it in terms of the same type of fundamentals, but Canada has an extremely positive story here as long as that population growth doesn't feed into such demand that we get inflation not going down and continued rate hikes by the Bank of Canada. For now, I would say it's positive for the housing market, and therefore I think it gives Canadian banks a little bit of an edge over the U.S. banks.
All right, we're going to have